Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Investors gear up for the Fed's big decision on Wednesday. The central bank expected to cut rates by at least 25 basis points, with some traders preparing for a larger 50 basis point move. Laurie Calvasina of RBC joins us now for more. Laurie, I know the house view is 25, and I just wonder if we get that 25, and of course, welcome to the program, by the way. If we do get that 25, how vulnerable certain trades like the small caps actually are?
Hi, John. So thanks for having me. Look, I think it's a great question, and we were watching the small caps just surge on Friday as the renewed optimism about the 50 basis point cut came up as well. And look, I think small caps have a lot going for them, but the reality is that valuations are full and positioning is also full. If you go back a few months ago, they looked underowned, they looked cheap. We're just not there anymore, and now we've got a lot of Fed optimism baked in. So I do think in the short term, at least, if we're just thinking about the week ahead, I do worry a bit that if we get the 25 rather than the 50, which propelled small caps to these great heights on Friday, that there could be a bit of a reversion in the small caps. I think that, we really have sort of more of the fast money crowd sort of driving that trade right now. If you look at recent flows into small cap, they have been all passive driven, and that passive money does tend to be very, very fickle.
You have a nuanced view here, Laurie, with respect to not only how much the Fed cuts, but also the economic data behind it that needs to keep this going. There was this feeling that the Fed was on track to cut by 50 basis points without real pain visible in the U.S. economy. How much is any kind of weakening, even if not a recession, sort of a bear case right now for small caps?
So I think the small caps really need the needle to be threaded. And what I mean by that is if you go back and look at past cutting cycles, small caps do really, really well and embark on a longer-term outperformance cycle if you get a recession, if you break the economy. It's small cap 101 to say you sell them on the way into a recession, you buy them on the way out. And you tend to see that pivot midway through. But if we don't get that and we get some sort of economy that's still growing, I do think it depends on what kind of growth we get. And if you look at the other side of the equation, we really do need a hot economy, above average GDP for small caps to really keep going if you look at recent trading data since, say, 2015, 2016. And if we're just, I think it comes down, Lisa, what do you mean by soft landing? A soft landing that's looking at like 1.5% type GDP growth, maybe even 2. I don't think that quite cuts it for small cap. I think you need something more like 2.5% to 3% or better.
When you broaden out beyond small caps, you say you remain neutral on the S&P 500 as we get closer to your year-end target. You talk about sentiment and how it concerns you. Can you explain why investor sentiment right now is a red flag?
Sure, it's a great question, Lisa. And look, I would say if you look at AAII net bullishness, I think that's the best barometer. It's been doing the best job the last couple years at calling short-term inflections in the market. And it's really flirting with danger if you look at where it's been recently. It's been kind of hovering right around that 1 standard deviation mark, poking above it on certain weeks, but not quite on the 4-week average. And that's very similar to what we saw back in July. That's very similar to what we saw back in August of last year. And if you look at CFTC data, which is going to give you more of an institutional look, that data just continues to make new highs, and it's above levels that we were at in early 2018 and early 2020 pre-COVID, and it's well above the highs that we've seen mark the peak in recent years in kind of that post-COVID era. Look, sentiment and positioning are not the only thing that drives stocks, and we certainly can stay overbought for quite some time, but I do think it tells me that we're really not sitting here in a position where we can absorb any kind of bad news easily. So those are charts, frankly, Lisa, that keep me up at night, even though we've had a more constructive view on equities overall.
Laurie, do you still see a connection from a Trump win and small caps rallying?
It's a great question, Anne-Marie. So, if we look back to 2023, 2024, we really just haven't seen that linkage, right, where Trump's doing well in the betting markets and small caps are outperforming. We've really seen Trump more closely aligned with large caps, with growth. Things are starting to change there a bit recently, so I would say we'll have to watch the data. One of the things we did mention in our piece this morning is that if the Harris corporate tax increases, raising the rate from 21% to 28% were to go through, I do think that's a negative signal signal for small cap, because if you go back into the 2016-2017 period, small caps were one of the big beneficiaries of the rate cut. And that's not just to simply say the historical playbook, flips on its head. We have to go back to the why. And what we found back then was that small caps were more direct payers of the headline rate. They had a tougher time managing their taxes lower than large cap companies did. So I think that issue may come up if we end up seeing Harris win and those corporate tax hikes are on the table. Of course, I think that really only happens, in a Democratic sweep scenario, which is not really our base case.
Lori, you've been looking at both of these candidates' plans. I saw you at Trump's economic speech here in New York City. What big questions are still missing as you think about and you put these into your models?
So look, I think it's really preliminary for both candidates, right? I think that they've both taken some heat for lack of detail. From my perspective, maybe my expectations are just low all around. I think this is maybe the fifth or sixth presidential election I've covered as a strategist. But I'm really just looking for kernels of where they're leaning, of what their wish lists are, of what their impulses are. So I think, when I look going forward, I think maybe on the tax side, for corporate taxes at least, we have a little bit more clarity on the Harris side. I left the speech confused about exactly what Trump wants to do in terms of further tax cuts. The commentary of linking the 15% rate to domestic production. I don't exactly know how that shakes out in the S&P 500. We have lots and lots of companies that are producing things overseas. So I think it's tough for me to sit here when I'm looking at my earnings model to just bake in a 15% corporate tax rate. I think it's much more complicated than that.
We feel your pain for policy on both sides. Lori, thank you. Lori Calvasina of RBC. Continue this conversation with Rob Casey of Signum Global Advisors. Rob, good morning to you, sir.
Good morning.
Another almost tragic event over the weekend. Two very lucky escapes over the last 2 months for the former president. What does this change? Does this change anything at all?
I don't think it changes a whole lot. Certainly not as much as the first assassination attempt, where we saw, photo after photo of Donald Trump bleeding, standing, raising his fist. This, a little bit less interesting to the general public. But I think it points to the fact that the October surprise this year very well could be an example of political violence.
When you look at the timeline to November 5th, does Trump need to change how he campaigns now?
I don't think he needs to change how he campaigns. Now, maybe we'll see him play a little bit less golf, but probably not. I mean, as the sitting president, he likes to travel to his golf courses. As a candidate, he's certainly done the same thing. Now, how he campaigns, I think this really only plays to his advantage. Now, obviously, we're all very grateful that he's safe, but up until that point where he's not safe, I think this riles up his base and ensures that Republicans will turn out in November.
Jack was just talking about what's going on with this task force. They're still investigating what happened 2 months ago. How quickly can Congress move and potentially beefing up his protection? We heard from the Palm Beach County Sheriff yesterday saying if it was the sitting president, potentially there would be a bigger perimeter around the West Palm Beach golf course.
Yeah, unfortunately or fortunately, it's not really up to Congress how good Trump's protection is, right? It's a question of Secret Service. President Joe Biden and Vice President Kamala Harris have assured us over the weekend that Trump's protection is good, right? It's as much as a candidate needs to have. But that being said, I wouldn't be surprised if they beefed it up pretty close to essentially what the sitting president receives. Now, Donald Trump is not the sitting president, but he's 6 weeks away from potentially being reelected. So I would not be surprised if President Biden, frankly came out and said, we're going to give Donald Trump more.
Rob, you said something that I want to pick up on. You said that the October surprise that we may see could be an act of political violence. What makes you say that?
Well, of course, we've seen 2 attempts on former President Donald Trump's life. So that's the first. The second is, our country is horribly divided. And I think to a certain extent, politicians are playing into that and will play into that between now and November. I think the example sort of coming from the other side is Trump and Vice Presidential candidate J.D. Vance, talking about these illegal immigrants in Ohio, Haitians eating dogs and cats, things of that nature. They're actually legal immigrants. But it's rhetoric like that I think, frankly, could incite this kind of lone wolf violence that is so hard to defend against.
So what's your sort of analogy? I mean, has there ever been a time or any other election cycle that you can think of that had this type of risk, or is this a new and heightened risk that requires a very different type of security and a different type of campaigning?
I think it's at least in the modern American era, this is new, right? We haven't seen attempted assassinations like this in my lifetime and in all of our lifetimes. You can go back to probably the Civil War to see when our country was most divided. I don't think we get there, right? And the hope is that the Secret Service is able to protect, obviously, the sitting president, the former President Trump, and Kamala Harris, and they're doing their best. And it's important to say that none of these attempted assassinations have been successful. Now, obviously, the first one was very close and very scary.
Yep.
Second one, not so much.
Let's talk about the Harris campaign. The first time, we had the Biden campaign, and the criticism at the time was that it was a one-dimensional campaign centered around characterizing Trump as an existential threat to democracy. There's a lot of criticism about that in the middle of July. Does the Harris campaign have enough facets to it? Is it a multifaceted campaign that they're not relying on this single issue, that they can back away from talking about this a little bit more?
Yeah, I think they can. The issue with the question of democracy as a campaign issue is that it's, 100% of people are worried about it, but it splits 50-50, right? Republicans are worried about how Democrats are a threat to democracy. Same thing, vice versa. So, did it incite the first attempted assassination against Donald Trump? We're not really sure. Who knows? The motives of that shooter remain unclear. But, as a question of, can the Harris campaign do more? They better, right? Because I'm not sure they're going to win on this single question of democracy. They have to win on abortion. There's more messaging around a middle-class economy and opportunity economy than we saw from Biden, who didn't want to talk about the economy at all. So Harris is doing more. I think she has to do more to win.
Talk to us about how Harris is addressing the U.S. economy, because we all saw that interview going into the weekend. It wasn't impressive. Some very simple questions that weren't really answered. What is the opportunity economy? What are the policies behind it?
I think the policies that she wants to highlight first and foremost are the housing policies. After that, it sort of falls off, right? And I think what's important about these policies, what many of us know, is that not a lot is going to get through Congress. So it's not as though she can promise, huge reforms, huge changes, because if she sits in the seat, if she wins the election, she's very likely going to have a divided Congress. And I would agree, John, that the interview on Friday, not all that impressive. I think it's probably why we haven't seen her do a whole lot of interviews, why we probably won't see her do a whole lot of interviews between now and November. On the one hand, she's a candidate who absolutely turns out the base. On the other hand, maybe that they want to do their best to insulate her and just maintain the momentum that they have, certainly that she won in the debate on Tuesday night.
Just quickly, just to wrap things up, base case for you and the team, what is it? Does it remain the same?
It remains the same. 65% chance Harris win. So we think that's base case. With a divided government, the Senate goes red, the House goes blue, and that really limits what Harris is able to do, at least until the midterms.
Okay, Rob, it's good to see you. Thank you, sir. Appreciate the input. Rob Casey there of Signum. I'm pleased to say that the boss over at PIMCO, Manny Roman, joins us now for the next 30 minutes or so. Manny, it's good to see you, sir.
Good to see you. Thank you for having me.
Put us out of our misery, 25 or 50 tomorrow. What's it going to be?
Well, we're in the camp of 25, but I always say we have a crystal ball, and at the end of the day, we'll see what the market does. It may very well be that it doesn't make that much of a difference, and our view is that there will be 3 cuts of 25. And at the end of the day, what matters is where we are at the end of the year.
Well, let's talk about the destination. This is a 3-part act on Wednesday, as you know. It's a decision, it's a set of forecasts, and a news conference, and a big conversation around this table for the last several months. What's the destination? What are they aiming for? What are they shooting for? Where does this land in the next 18 months?
Well, I think you can say that there's less inflation right now, and that in the absence of new data, the destination will be to have lower rates, and the Fed will be very data dependent. And I think sometimes one underestimates how careful they are about new data and how they want to be able to change their opinion. And so if you kind of use this framework, you sort of say, let's do 25 and then let's see where we are, and then probably do 25 and 25. But I think the total sum of the rate cuts may matter more than how they do it.
Which is the reason why people are looking forward and saying maybe the neutral rate's 3.5%. And oh yeah, look at that. The 2-year yield right now is about 3.5%. Back in June, when you put out the outlook for PIMCO, there was a feeling that intermediate bonds really had a fantastic investment proposition just simply because there was yield. Do they still, after the rally we've seen?
We still do think so. And listen, the exciting thing about being at PIMCO right now is that fixed income is quite attractive. And we are in a business of feast and famine, right? So when rates are very, very low, it's harder to be that excited about fixed income. And when you can build portfolio and get a yield of 6.5, you become very excited. And we're very focused on Treasury. But the reality is there is a lot of value in other part of the segment, asset-backed being one of them. And, we're excited about what we see. And at the end of the day, the yield on the portfolio is a good predictor of the return that the investor will experience. And so what I think is exciting about fixed income right now is you can build a portfolio and get a return of 6.5% with a series of different instruments.
It used to be that bonds did better in bad times and worse in good times. Are we heading into a worse time where people go to bonds for safety, or is this on just an absolute basis, yields are higher?
My partner Dan Iverson, and I'm going to quote him because actually he has a very good line. Bonds may be the most attractive asset class. And I think that there's an absolute argument and then there's a relative argument. And I think the relative argument is to say you need to build a portfolio, you need equity, you need fixed income, you need some real estate, you need some private asset. And at the end of the day, fixed income is much more attractive than equity given the earning yield and given the valuation of the equity market. And I think that's one of the arguments for owning a larger part of fixed income. And I think when I travel the world, I think that people are underinvested in fixed income, and a lot of them are looking at putting more money into fixed income. And whether they do it tomorrow, whether they do it 2 weeks from now or 2 months from now, I don't know. But the reality is people were underinvested various parts of the fixed income market, and they're looking to readjust their allocation.
Have you got confidence we've reestablished the inverse correlation between bonds and stocks?
I don't know what I don't know. And I think correlation fluctuates over time. I think that fixed income have a role in the portfolio construction, and I think they're there for a reason. But of course, credit spread in the high yield market are correlated to equity prices. So once again, I think one needs to be careful about how you frame the question and how you conclude.
Well, I guess I would be more specific by saying, have treasuries re-established an inverse correlation with equities? Because one of the risks that we've seen established over the last few years, particularly given the central focus was inflation, is that when bonds sold off, equities did too. Have we changed that story? Have we left that behind?
Hopefully we have. But I think remember that we also saw with the pandemic really an unprecedented program of money creation, which sort of threw everything and our economic textbook in terms of how we thought about the correlation. And so I'm careful about what I say because the data are just so skewed in terms of what we saw. And I think, you can make the argument, for example, that part of the reason why the US economy has done so much better than any other places is that the package in terms of the pandemic has been so much bigger than in other country. And at the end of the day, all you can do is cross-sectional analysis and try to compare different countries, but there's so many other variables that comes into the picture that you don't want to understate the enormous creation of great company in the US versus Europe, for example. And so I think we try to always be careful about making definitive conclusion when it comes to correlation and when it comes to cross-sectional comparison between different countries.
Another way to frame this question is when you travel the world and you talk to international clients who are underinvested in fixed income in the United States, how many of them turn to you and say, what about the US deficit?
Well, my friend and partner, Richard Clarida, used this very American expression and says the U.S. is, let me try to make sure I get that right.
Carry on.
The cleanest dirty shirt. And, we have debated quite a bit at a forum about deficit and deficit do matter. And they do matter. And at some point in time, there's a tipping point, but we're not there. And the reality is it's a huge competitive advantage to be the reserve currency. People need to own dollars. And the reality is we don't think there's a crisis coming and that the US can have certainly a high level of debt versus historical precedent and be able to function just fine.
When will the US get there? And do you see either party have any impetus to try to rein in spending?
So to quote my partner once again, Libby Cantrell, who comes often here on the show, no, we see no impetus to try to deal with the budget deficit. The only real example we have is the United Kingdom. And I think that the United Kingdom was actually quite interesting because you saw a situation where the bond market reacted so violently to the Liz Truss proposal that all of a sudden they had to change and had to change really, really quickly. And I think that this example of what happened in a very developed country and how the Bank of England reacted really quickly with the LDI situation and the pressure in the gilt market and in the pension market will be a textbook example of why markets react quite strongly when something outrageous comes.
Well, we have a Bloomberg survey to that point that says Kamala Harris, a victory for her in the White House would be better for treasuries and worse for stocks, vice versa for the former president. Would you agree with that scenario analysis?
I think there's so many unknowns. You know, it depends on what happened in the House. It depends on what the winner can do in terms of program, how this is all going to pan out. I would be very careful about making any prognosis on this matter. I think, you know, when we think about the world, you know, I realize politics is really important.
Yeah.
But at the end of the day, that's not how we invest. We invest because we find value and we find opportunity and we try to buy cheap and we try to manage portfolio and think about risk carefully and ride different cycle and deal with many other factors than politics. And you know, there's a few exceptions. If you talk to my partner Pramal Dawan in emerging market, all of a sudden, in emerging markets, sometimes politics do really matter because they are very big changes and very big different outcomes.
The struggle, Manny, as you know, is that some DMs have traded like EMs over the last few years. And you mentioned the UK, so I won't put words in your mouth. I do want your views.
Well,
it does feel like a self-imposed debt break in the United Kingdom. And I'm wondering whether, from your perspective, for you and the team, that actually makes UK government debt a little bit more attractive here.
We think it's very attractive. We like the UK, we like Australia. We think that the UK fits very well in the portfolio and they will need to cut rates significantly. And so when you think of a global outlook, the UK looks good for a fixed income investor.
Relative to the United States, say, in terms of duration risk?
Relative to other countries in Europe, certainly compared to European bonds. We also like the US, so, you know, if I want to kind of sum up things, you know, we like the US, we like the UK, we like Australia.
The 2-year, 10-year segment of the yield curve, things just starting to normalise, bit of steepness, almost back to double figures this morning. As we get that curve normalisation, can you walk me through how much things change in fixed income, whether you're starting to see that cash deployed a little bit more?
Well, I think there's that, and of course, people kind of look at the cash they have on the sideline, and there's about $10 trillion of money in cash where they will think to reinvest it, either by extending duration or by going longer or by taking a bit more credit risk. So there is a wall of money out there. And I keep on saying this. And of course, some of it is cash corporate and will remain cash corporate. But I think people have been very much on the sideline rolling short-term treasury bill. And this money will get redeployed. And how fast and how remains to be seen. The other thing which I think you may find interesting is there are a lot of opportunity in relative value in the fixed income market, and in particular, think of Japan. You know, nothing happened in Japan for 15 years, and then all of a sudden, we now have positive rates in Japan. And there's a lot of arbitrage to be done. It's across the curve, it's with swap, it's with different instruments, and all of a sudden, there are sources of alpha, as we tend to call them, where basically they didn't exist 2 years ago, which have come back to the market in spade. How long it lasts, we'll find out, but it should be a very exciting opportunity in terms of the whole market, in terms of delivering better performance.
How difficult is it to pry that cash out of people's cold hands, given the fact that people really do like what they're getting? And, oh, by the way, there are 15 other fund managers out there also trying to get them to pry that cash out of their hands.
Well, I will tell you, competition is good for everybody. And at the end of the day, there's two things. There is, when the Fed cuts rate, eventually the short end of the curve becomes less attractive, and I think you'll see cash moving. And from a competitive standpoint, we want to do the best possible job in terms of being a fiduciary and doing a good job in terms of performance and being there for our clients. And we compete every single day. And hopefully we win more than we lose. But all we can do is try our best, and we're trying very hard.
Where's the edge? Where's the sort of growth concentrated in, or is trying to be concentrated with respect to PIMCO in the, say, 5 years ahead?
Well, Asia has been quite exciting lately, and there's a lot of things happening in Asia, and you can sort of think of a business as being linked to GDP in terms of the saving rates, and people, when they save more, invest more, and so Asia has been quite exciting, and the US is an absolutely wonderful place. I mean, it's a big market, and there's a lot to be done. We have a very good Canadian business, we have a very good Latin American business. There's a lot of good things happening, but the one variable we don't control is, of course, the macroeconomic situation. And so if you have a real reversal and you have, for example, a recession, and let me just say it's not our scenario, but if you have a real recession, people become more risk averse and take some money away. And at the end of the day, we're here for the next 20 years, not for the next 20 minutes. And so, we have very liquid portfolio. People can take their money whenever they feel like and reinvest and so on. And we understand that people need money for all sorts of reasons.
There are a number of behemoth asset managers. PIMCO oversees $1.8 trillion. How much bigger could you see it getting?
It's all about performance. And I always say the great thing about not being public and not having to give quarterly earnings is you focus on what matters. The circle of truth is if you perform, they will come.
You said this last time we spoke. Don't measure our success by assets. We measure our success by the returns we provide. Does it disappoint you? Is it slightly upsetting that people do measure your success by assets? Because they've been pretty stable now for the last decade. BlackRock over the same period has multiplied. Is that disappointing to you that people judge you by that?
I think we have a very different business model. And, we were talking about Walmart. We don't want to be Walmart. Walmart is a fantastic company, but we have an opportunity set where we very carefully think about capacity and how much money we can put to work and what the right target return are for investors. And I think that, by definition, means that we won't be the largest asset manager, and so be it.
When it comes to asset management, private markets comes up all the time, and everyone's trying to make their own push. Where does PIMCO fit into that big push at the moment into private markets?
So we try to focus on what we know how to do. And what we know how to do is fixed income. And so that includes, as a matter of fact, everything which has to do with private market and fixed income. And it also involves real estate. And there's a big real estate cycle that should be exciting. There will be pieces to pick. And there will be cheap investment, both in debt and in equity. And in the private credit market, there's quite a unique opportunity in asset-backed lending. That's where my friend Dan Iverson grew up in. We have been doing this for 20 years. And the one thing which has changed, so to speak, is the banks need to free up capital. And so they need to sell large portfolio of many different assets and do it fairly quickly. That's an opportunity for us. And so if they are good entry point and good asset to pick, we should be able to do quite well.
What types of assets? Are you talking about commercial, or are you going to be owning
loans,
big residential
mortgage,
swaths?
All bonds
Rental
that
homes?
Banks... Let me just focus first on fixed income. I think in fixed income there's a lot to buy. And there's a lot to buy because the banks need to delever. And so the banks, you can think about what they have on their balance sheet. They have loans that they've given to company and they want to get rid of it. And so they sell it to us. And that, I think, is fairly straightforward. In real estate, you have a real estate cycle. And there will be different things you can do. Some will need pref equity. Some will need debt. Some will need to buy equity, and we just need to make sure that it's cheap enough and that we think carefully about what happens and make sure we have an expected return which compensates for the risk. And it needs to be high because there's a lot of risk in commercial real estate, for example. But we had a pretty fast cycle, and hopefully we're going to be on the right side of the trade coming out of it.
We've only got 60 seconds left with you, so the hardest question of the morning. What's more likely, Arsenal winning the title or the Federal Reserve engineering a soft landing?
Arsenal winning the title.
Arsenal winning the title.
Yes.
Should I read into anything about your real views on the economy then, based on that, or you just think Arsenal's that good?
No, you should. You should think about Arsenal. No, I think. Look. I think people are very. Sometimes criticize the Fed. I think they do a really, really good job with a very difficult hand to play, and they don't know what they don't know. At the end of the day, and I think it has been a tremendously complicated market to navigate for everybody over the past 4 years. None of us ever thought we would see a pandemic, and from an investment standpoint and from a regulatory standpoint and from the Fed standpoint, I think we had to learn a new playbook.
It's been humbling for us all. Manny, it's good to see you. And great win over the weekend. Thank you, sir. Appreciate it. Manny Roman there of PIMCO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.